All right, pause your scroll for a second and lean in because something just happened in silver that you don't see very often. Overnight, silver dropped from roughly $120 an ounce to about 97. That's a 21.5% move in less than 24 hours. Let that sink in. Roughly $1.4 trillion dollars in notional value vanished almost instantly. And here's the part most headlines are missing. The real trigger isn't collapsing demand or some secret news leak. Both major futures desks and physical market desks are saying the same thing right now. This was mechanical. This was leverage. And if you stay with me, I'm going to show you exactly why this matters, how to recognize it next time, and what you should actually be thinking about today. If you're holding silver, if you're watching it, or if you've been waiting for a moment like this, your job right now is to understand what actually happened, not what the panic merchants are selling you. Before I explain what caused this, let me teach you something most people never really internalize about markets. Prices don't just move because opinions change, they move because positioning changes. Think of a crowded elevator. Everything feels stable until one person stumbles, and suddenly everyone has to react at once. That's leverage in action. In parabolic markets, leverage stacks up the same way. Traders borrow against rising prices, brokers allow it because volatility looks calm and everyone feels smart. The collateral looks good, the trend looks unstoppable, and the risk models say it's fine. But when price slips just enough, the elevator jolts. Margin calls don't care what you believe. They don't care about your thesis or your conviction. They just liquidate. And here's what separates professional traders from everyone else. Professionals watch positioning as closely as they watch price. Because when leverage builds up, you're not just looking at supply and demand anymore. You're looking at a ticking clock. So, what does that tell us? It tells us that a 21% drop overnight isn't necessarily about silver's value changing. It's about the market resetting who's allowed to play. Now, here's what's actually happening under the hood. Silver had gone parabolic. We're talking about a vertical move that felt unstoppable. Futures leverage expanded aggressively. Open interest ballooned while volatility stayed deceptively quiet. That's the setup. That combination right there is what professionals call a powder keg. Because when open interest is high and implied volatility is low, it means everyone's betting the same direction with borrowed money, and nobody's worried. That's dangerous. Then price dipped. Not dramatically at first, just a few percentage points, but enough to trigger initial margin calls. Those forced sales pushed price lower, which triggered more margin calls, which triggered more selling. That's the cascade. And this is critical to understand. It's not emotional panic, it's automatic selling. The systems don't have feelings, they just execute. Broker says you need more cash or we close your position. You don't have cash, position closes. Multiply that by thousands of accounts and you get an air pocket. And here's what's wild about this sequence. The physical market didn't disappear. Coins, bars, and industrial demand didn't suddenly evaporate by 20% overnight. Walk into a coin shop today and they're not dropping prices 20%. Call up an industrial buyer and they didn't just cancel their orders. The paper market deleveraged fast and hard, while the physical market basically shrugged. That disconnect is your tell. That's how you know this was a leverage flush, not a fundamental repricing. But here's the part that should make you pay attention. So when futures liquidation hits all at once, price doesn't discover value gradually. It air pockets. That's why you see a move from 120 to 97 without stops holding. There's no orderly step down. It's gap, gap, gap. And now let me show you what most people are missing. These kinds of collapses usually happen near inflection points, not at the end of long-term stories. Read that again. Near inflection points, that should make you pause. Because when leverage leaves the system, when all the tourists with borrowed money get flushed out, what's left is actual price discovery. What's left are the buyers and sellers who actually want exposure, not the ones who wanted a quick flip on margin. Let me give you the numbers that nobody's really connecting yet. In the 72 hours before this drop, futures open interest was sitting near historic highs. I'm talking top 5% of all time. At the same time, the CBOE volatility measures for silver were in the bottom quartile. High leverage, low fear. That's your warning sign. Every single time you see that combination in any market, you should be thinking about what happens when the music stops. Zoom out for a second because this playbook is familiar. In 2008, silver collapsed during forced liquidation as funds blew up. then rebounded violently as stability returned. I remember watching silver go from near $20 down to under $9 in a matter of months. Everyone said it was over. And then what happened? It rallied to $48 by 2011. In 2011, after a leveraged spike and a brutal margin hike cycle from the CME, silver fell fast, consolidated for months, and then entered a multi-year repricing phase that ultimately set up the next cycle. In March of 2020, everything that could be sold was sold, including silver, even as physical premiums exploded globally. You couldn't buy a silver eagle for less than $8 or $9 over spot, while paper silver was trading in the teens. Every time this has happened, the crash wasn't the story. The transition afterward was. When you look at the pattern, the key feature is time compression. Fast drops driven by leverage tend to exhaust sellers quickly. Slow drops driven by fundamentals don't. That distinction matters a lot. If this drop took 6 months, I'd be concerned about the underlying story. But when it happens in one day, that's mechanical. That's forced selling meeting a lack of bids. The larger story here is that silver is moving from leverage-driven price discovery to fundamentals-driven price discovery, and those are very different environments. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep going lower? Of course. Markets don't owe anyone a bounce. We could see $90. We could see 85. And yes, there are always claims of manipulation floating around after moves like this. Big banks, secret sales, conspiracy theories. Here's the thing. Whether or not you believe that, it doesn't change what you can control. You can't trade narratives. You can only manage risk, timing, and exposure. Even if there's manipulation, even if some entity wanted to crush silver, the mechanics still work the same way. Leverage still unwinds. Forced selling still happens. Focus on what you can see and measure. Emotional reactions right now are expensive. Structured thinking is cheap. There are probably three types of people watching this right now. First, you're already long, maybe from much lower levels, and you're staring at your screen wondering what just happened. You bought at 30 or 50 or even 80, and you believed in the thesis. Let me say this clearly. If your thesis was long-term and nothing fundamental changed in 24 hours, your decision framework shouldn't change either. Did solar demand disappear? Did electric vehicle production stop? Did monetary policy suddenly become hawkish beyond expectations? No. Then your thesis is intact. Time horizon matters. If you're thinking in years, a one-day move doesn't invalidate your position. It tests your conviction, but it doesn't change the macro setup. Second, maybe you sold earlier or got stopped out and you're feeling relief mixed with regret. You sold at 110 or 115, and you're grateful you're not holding now, but you're also wondering if you should jump back in. That's normal. Your job now isn't revenge trading, it's patience. Let the market stabilize. Let price prove it can hold a level. Don't chase this down. Don't try to pick the exact bottom. That's ego, not strategy. Third, maybe you've been waiting for a pullback like this and you're eager to buy the dip. You've been watching silver rip higher, you missed the move, and now you're thinking this is your chance. Here's my caution to you. Forced selling doesn't mean instant bottoms. Sometimes the best entry comes days or weeks after the initial flush, when volatility compresses and price starts building a base. Let the dust settle. Let volatility compress. Let price prove itself. I know it's tempting to hero buy the low, but more money is lost trying to catch falling knives than waiting for confirmation. And the universal principle for everyone watching is this. You don't get paid for predicting drama. You get paid for managing transitions. Whether you're long, short, or flat, your edge comes from reading what stage the market is in and positioning accordingly. Right now, we're in the flush stage. Recognize it for what it is. So here's where I stand. I'm not panicking and I'm not blindly buying. I'm watching. First, I'm watching the $95 to $100 zone to see if price can stabilize without violent spikes. If we see silver chop around in that range for a few days with declining volume, that's healthy base building. If we see wild swings up and down, that's continued instability. Second, I'm watching volatility. I want to see it contract, not explode. When implied volatility drops back toward normal levels, it means the market is pricing in less chaos. That's when smarter money starts coming back. Third, And this one matters more than most people realize. I'm watching physical premiums, especially in Asia. If those stay elevated while paper prices compress, that's historically been a warning sign of upside repricing ahead. When paper and physical decouple, pay attention to which one the real buyers are following. Based on my analysis, this drop was mechanical, not emotional. Structural, not random. The fundamentals didn't change by 20% overnight. Industrial demand is still strong. Monetary conditions are still accommodative. Supply is still constrained. What changed was leverage. What changed was who's in the trade. If history rhymes, and I think it does more often than people admit, the next phase won't be about leverage. It'll be about value. And if silver can stabilize and hold above 95, the move that follows could be significant. I'm not predicting exact targets, but I'm saying the setup looks familiar. I'm not a financial advisor. This is not financial advice. Do your own research. Verify the data. Check multiple sources. Don't take my word or anyone else's word as gospel. But if you made it this far, you're thinking like a market participant, not a gambler. That mentality will serve you well. If this breakdown made sense and helped you understand what's actually happening versus what the headlines are saying, drop a comment below. Tell me what you're watching. Share this with someone who needs to see it. Subscribe if you want more breakdowns like this where we cut through the noise and focus on the mechanics. Stay sharp out there, think critically, verify the data, and make decisions that match your time horizon, not your adrenaline.